what we found is like the some of the tooling that we use with Kemet has given us like some flexibility in terms of how we operate in those different modes. And it can be helpful from like an edge perspective, like in terms of just capturing more edge.
Welcome to Derivatives Decoded. I'm your host, Ash. I'm the founder and CEO of Kemet Trading, where we provide a pure technology offering for institutional participants to trade and manage digital asset derivatives. Please follow me on this journey as we bring in some of the best industry experts to talk more about derivatives, explain very complicated ideas, and break them down into things that make a lot more sense for all of us. This is our first episode. We here at Kemet Trading believe that there's a lot that the audience that is interested in derivatives needs to know, especially around digital assets. So I'm very excited to introduce our first guest here on episode 1, Josh Lim. Thanks for being here. And why don't you introduce yourself for everyone that's listening to this?
Yeah, thanks for having me. Yeah, so my name is Josh, and I started a firm called Arbelos Markets. We are focused on providing principal liquidity in crypto derivative markets, which has become a pretty big part of the whole industry. Obviously, crypto derivatives started as more of a retail instrument to get leverage, but now it's much more widely used by institutional market participants to get exposure. I started my career in more traditional markets, in equities, and became enamored of crypto in 2014. Started working at a firm called Circle, which before was a stablecoin issuer, was a trading business, a consumer-facing sort of app that allowed people to buy and sell crypto. And so I started there and gradually over time became much more enmeshed in like the institutional side of crypto as the asset class itself became more accessible to larger investors. And that brings us to kind of today, have harnessed a lot of the things I learned at Circle, and then was at Galaxy for a bit, at Genesis, which were both two large institutional platforms, and sort of tapping into that and building this firm, Arbelos, that's sort of more narrowly tailored towards crypto derivatives, talking to those institutional investors that trade them, and then structuring things for them.
I'm pretty sure you're one of not too many people that kind of like made the switch from TradFi into this space altogether, right? And I believe you had some time at Goldman at some point. And I mean, one of the key questions that I guess a lot of people always tend to ask themselves about, like, trading derivatives in this ecosystem compared to TradFi in general, which I know some of that, some of these very deep troubles are what Arbelos is trying to solve for. Right. How can you describe some of those like stark differences? What do you see are major pains, especially around derivatives in this space?
Yeah, I did start in equity derivatives, and I think a lot of the trading sort of people that get into crypto come from more traditional markets or are more classically trained. A lot of Wall Street people, a lot of commodities, FX, equities, all types. I think that's one of the things that makes crypto beautiful, is it's like, because it's such a greenfield kind of industry, a lot of people with very different perspectives on how markets should trade came in and sort of carved out different pieces of the landscape to build around. That's why you have like a lot of FX people trying to build sort of FX like infrastructure, and then you have a lot of equities people who think it should look a little bit more like equities. My personal take has always been like, I think the options market in crypto trades a lot more like equities, just given how high vol it is, and that it's not very like mean reverting, I guess. So I think the one thing that you see a lot with people in traditional markets as they come into crypto and adapt is like that it's such a different stage, right, in its development as an asset class. In traditional markets, like very static and mature and very competitive, like very sort of like, your margin is another person's opportunity to sort of like undercut you and take you out. In crypto, because it's newer, there's a lot more opportunity to sort of like collaborate and create positive sum outcomes. That's kind of the hardest thing for me as I've come into crypto and sort of transitioned into role here and trying to build a business here. And yeah, I think you could sort of ask like, what are maybe the lessons like coming from TradFi into crypto? Yep. And it's hard because in traditional markets, like you're constantly worried about your downside tail risk, right? And that's sort of like what you see in these big deleveraging moments like we just saw with the yen carry trade is people are hedging and they're protecting their downside.
Why don't I stop you there for a second? Actually, why don't you, in very simple terms, explain what happened with that yen trade? Because I think a lot of people there was a lot of information and there's a lot of sort of, different views on what exactly happened, less than a week ago.
I guess the short way to describe it is, there's a very popular trade, which is like a carry trade, which is basically like to borrow in a low interest rate currency and then invest it in higher risk things that have potentially higher returns. And that works well in most environments, but when everyone's sort of scrambling for the exits, then it can result in a very large unwind and sort of like a sudden loss in capital on that trade. So it's sort of like a short vol strategy, right? Like you're usually making money because implied vols are higher than realized, and then suddenly you'll lose all of it. So that's sort of what happens in these sort of carry trades, and that's what happened, last week, which has kept me pretty busy this week as well, dealing with all that. But that's sort of what people are constantly focused on in traditional markets. You're always thinking about like what's the worst downside scenario. It works well in a lot of asset classes, right? It works well in equities to think about those sort of tail scenarios. If you're, for instance, like a distressed credit trader, that's like your entire job, right? Is to think about like the worst case outcomes. In crypto, it's hard. You kind of have to flip your mentality of like thinking about the upside risk cases. And some commodities too are kind of like this, right? It's like the upside crash scenario of what if something really big happens that results in like a flood of new capital coming in and breaks the market to the upside, like liquidations to the upside. That's why, sometimes the vol curve, that the upside call wing is very well bid, especially when you have people anticipating like a very big event like the Trump speech,
for Bitcoin the Bitcoin Ashmawy,
right? That was like something people highly anticipated. He would say something about like a strategic reserve or something about Bitcoin. He kind of mentioned it at the end.
Do you feel the crowd was a little bit disappointed at like what the outcome of that speech kind of turned out to be? Because I think a lot of people were expecting a massive explosion.
Priced in, right? It's kind of the right way to put it is like, it was a base case for a lot of people that he would say that. And so that's why you I kind of think that without the anticipation of that and maybe sort of the ETH ETF stuff the week before, prices would have been lower anyway, like maybe around where we are today, like the low 60s. But because of those two events, like you saw the price go all the way up to 70K. And so like the events really since that, touching that, high point post-speech, to now are really just like a give back reversion of all of that anticipation. So that's like one way to think about it.
How do you explain the chargeback, I guess, from that pull? Like we went all down almost to 49K and now we're back almost to 60K or so. I think a lot of people everyone was basically, sounding the alarms on CT, talking about like we're about to go into like this major recession, like, nuclear war is about to happen between Israel, a bunch of countries. And then like, just like a lot of different situations where it turns out that like, or at least it feels right now that it's just a price correction, not really something that's extremely systematic like some people were talking about. What are your thoughts on that? Do you feel that this is, was a bump in the road, or do you feel like this is just a, one last, charge back from crypto until like it really starts going down and extremely price corrects to, sub 40, sub 30 kind of situation? Like, where do you see that like going?
Yeah, I think it's a case of, you have these large squeezes or liquidations on both sides, right? Like we had the squeeze up to 70 and now we had a squeeze down to sub 50. It does show how quickly liquidity can dry up in crypto relative to other markets, because crypto is like it's still kind of an insular asset class, right? It's like there's some pool of capital in it, but it's not easy to move capital in and out of it. It's becoming easier now with the ETF, obviously, but that's really just for Bitcoin. There's so many other assets that are in our industry. So it is constrained in that way. And so you do have, in moments, especially when like your largest liquidity providers are particularly stressed on other asset classes, that can result in just liquidity evaporating. So I think it's a little bit of that. There's obviously like a whole spate of rumors on what exactly happened, but I guess it's important to note that there were a lot of stress events in many other asset classes, including like if you look at where the VIX was trading, right? It reached levels that you would normally only see in like major financial crises where, you have, potentially like multi-year, like deleveraging ahead of you. In this case, like I think a lot of pundits have said, basically the leveraging is mostly behind us. It happened pretty quickly. So yeah, it's interesting. Like I think I don't have particularly like I'll just admit like I'm not an expert in this FX trade. So like I don't know exactly the extent of the deleveraging. And I think that was the position of most people in crypto over the last weekend, where it was like you have, and it's always this too, is like whenever there's a big move one way or another, like you almost need just 2 or 3 big confluence of just like catalysts, where you might have experts, like if it's one catalyst, right? You might have an expert that could understand and fully price that in, and they'll like basically help keep price at a reasonable level. The problem is like once you have multiple things happening at the same time, right? Like you have maybe geopolitical risk, you have like a bunch of liquidations from, GOX and Genesis and other things. And then you have like this carry trade unwind, right? So it's like now you have 3 things. If you might be an expert on 2 of those things, but the third thing might be just a complete wild card to you. And so like now you kind of have to take risk off the table, because it's like, all right, and then there's like too many things happening here. So now I have to like declutter my portfolio. And so I think that's why it happens, where it's like, oh, why is this? Why do you only get these moves when there's like 3 or more things happening at the same time? It's because of that.
Because they are happening at the same time.
There's like one thing that you don't really fully understand.
Yeah.
To take risk off.
Do you feel like the anticipated like Fed rate cuts that are coming, hopefully the next couple of months or so, like, is that going to affect sort of where we're heading as an industry altogether? Like, or like, I guess I really want to get your thoughts on macro correlation with this specific asset class, right? Also seeing that we're heading towards an election, and, right before Kamala just, became the runner, right? Like everyone kind of was pretty much felt that Trump is just going to take it, right?
Right.
Now things are pretty swinging, right? Like everyone kind of feels that like this might not happen. So the question is, with those 2 events kind of happening in the next couple of months, where do you see the industry kind of going? Where do you see sort of liquidity being driven, right? Like around these asset classes?
I think it's hard. So, okay, I'll just say for the political stuff, like I think we live in a little bit of a bubble in crypto, where everyone kind of has the same narratives and circulates the same narratives, and we all kind of want the same things. So it's like hard to find fair value for the probabilities of these things, and you can kind of see it in the way like prediction markets that are in industry versus out of industry like price things. I do think that there's like an arb there a little bit, like the way things are priced and reflected in the underlying asset, the underlying commodity of Bitcoin, or like the vol levels of Bitcoin, are often pretty out of whack with like what these sort of prediction markets or polls are saying. And it's because like people just get into a narrative mindset and they don't think about like what is the potential price impact of something happening. Yeah. So if there's a huge probability of, Trump winning, and then like the sort of strategic reserve where the style of which like, there's a mandate to buy like a bunch of Bitcoin
from the US government.
Happening. Like the price impact would be much, much bigger, and like the vols would be much higher. So, I mean, even today, right? You look at the vol curve, it's like, it's actually very flat, like out in the kind of like 3-4 month time frame, which is very surprising. Like I think it's actually underpricing like the election risk. I actually think like it's going to be a dead heat, like all the way up till the end.
Okay.
I think what people are paying attention to are like these sort of points where there could be big swings, like the debate in September. Yeah. And then there'll be much more clarity in the polls like post. But I do think like it's underpriced, like how much uncertainty there is going into that November election, that November date. Derivatives did add that like 8th of November date, which is kind of nice.
Yeah. So how do you see like, I mean, obviously the inflows into the Bitcoin ETF compared to inflows towards like the ETH ETF, right? Right. There's a lot of hype around like ETH specifically, kind of maybe just following with the same sort of interest that came with the Bitcoin ETF when it got approved, and it looks like that's really not happening right now, right? And I guess I wanted to get your thoughts as someone on the forefront of like dealing in that space, especially trading volatility, right? Like, how do you see those ETF products now, sort of in the time horizon of the next like 12 to 18 months, affecting sort of the liquidity and the players coming into the space? Like, has this already been priced in terms of on that horizon, or do people still, are undervaluing like the effect of these things and are constantly just focused on the immediate price movement rather than where those
future?
Yeah, exactly.
That's a good question. So I think what is happening with the ETH ETF and the sort of like maybe perceived underperformance relative to the Bitcoin launch, I think it's actually just realizing about a year or year and a half of this sort of like narrative shifting on ETH. And basically the narrative shift is ETH is a token that derives its value from like a network effect and is effectively like a bet on growth. And that's how it's always been valued. And for it to really achieve like the next tier of market penetration and sort of like, achieving like a much higher valuation, like an order of magnitude higher valuation, it basically has to make a jump into like a store of value type of asset, like a monetary asset. And like people have tried to make the case that ETH does have that property because it's ultrasound, like it has this sort of like deflationary property because of the post-merge, the burn and stuff like that. The issue is that
but does it have to only be that? I'm sorry to cut you off. But the question is like, what about if what about like you build a new Facebook on like on an EVM? Like if you do that, if you get to 1 billion users on ETH, right, for one of the apps, that like wouldn't that like drive the value to where it needs to go? Right?
Yeah. No, the problem is like if that's the value that you ascribe to ETH, then like the issue is it has to actually live up to that goal, and it has to actually do that and compete with other ones trying to achieve the same thing, and also its own L2s. So that's the issue, is like it already got fully valued for that type of thesis, and then now Solana, and then now like maybe the parallelized EVMs and like all these other things are coming out, and those effectively fragment like the investor base for ETH, because they're also tokens that can be held in investor portfolios that produce, that sort of subscribe to the same thesis.
So do you feel the vast majority of the builders in the space feel that ETH has kind of like just capped on its potential altogether?
No, I don't think it's capped from like a builder perspective, right? It just has to like, I guess the question is like how much was already priced in. And if some fraction of that price was like ETH can be this monetary asset, it feels like that probability has gone down substantially, as the realization that like, hey, it's actually just Bitcoin, because now Bitcoin has this ETF, and that sort of enshrines it as this like unique first mover, global reserve type of, non-sovereign store of value.
So you're a counterparty to a lot of different like institutional participants in the space, right? Like, why don't you explain to me and anyone like sort of listening to this, like what are some of the biggest pain points that you see a lot of your clients kind of like dealing with as they're entering the space, whether they are veterans in crypto or perhaps like new entrants as they start sort of touching this asset class? What are the biggest hurdles that they see, as specifically, as a client of yours?
There's a reason that people come in and talk to us and trade derivatives with us, right? So the reasons are basically access. So a lot of firms, especially the more institutional firms, maybe don't want to touch crypto directly. They don't want to touch the physical commodity. They want to actually just have synthetic exposure to it. So the easiest way to do that is through derivatives. And there's many types of derivatives in crypto. Like you can trade it directly on an exchange. So the second reason is, why would you talk to a dealer versus an exchange is for, let's say, for price competitive reasons, right? You might be able to get liquidity at a better level because at a certain point where you're trading and moving a lot of risk, it's more efficient to actually do it versus a counterparty that can actually find the right place to place that risk. Right. With a broad enough network that they could find the other side of the trade. And it's more efficient to do that than to sort of like go and hit an intermediary, sort of market maker on an exchange that has no appetite to hold that risk in with a long duration. And so they're just basically pricing it to how can they get out of that risk quickly. So that the price that you're ultimately going to get is worse than if you were to face someone who could actually get out of the risk efficiently. That's another reason, price. So access, price.
What drives them specifically towards you also compared to other sort of different players, right? So the question is, and also this might sort of, take us a little bit into a peril here. I'm like, do you feel there are enough dealers in this space that are, big enough, trusted enough to kind of really scale this industry and kind of like get it to a point where it is actually capable of taking on an institutional participant, like from the TradFi side of the world, where they, they're used to certain ways of dealing with things. Like they're used to managing risk in a certain fashion. They're used to, moving money at a certain scale. How do you feel about the maturity of the dealer space within crypto derivatives altogether?
I believe that it changed. I mean, it's changed a lot, even just in the time that I've been in the industry. It used to be that the dealers were effectively startups, right? Startups that had raised venture capital and had some basically equity capitalization that they could use to start a balance sheet.
Yeah.
And now it's firms that are extremely well funded or maybe even publicly traded, tapping like more traditional sources of debt financing, either issuing bonds perhaps or engaging with like large traditional financial sponsors to get balance sheets. So that's a big change. I think in being a dealer or like a sell side kind of market participant, ultimately there's only a couple dimensions on which you can compete. It's like, the scale of your balance sheet, maybe the quality of your network and your relationships, and then also just like your creativity of sort of structuring and providing solutions to people. So like product innovation. And then probably the last category is
Fees, maybe.
Yeah, well,
right?
yeah, pricing,
Yeah.
maybe like technology, like just your efficiency of actually accessing markets.
The overall user experience for that client, right? Like dealing with you kind of also does play a role in that trust, right? It's not just I trust Josh, but I'm going to talk to him over Telegram and that's as far as it goes. But if you do give him a better user experience, that kind of also gives you that sense of maturity, right?
For sure. Yeah. I mean, all those dimensions matter. And I think there's been sort of progress over time, like the dealers focus on all of these different dimensions and have improved on them. And I'd say right now we're at a stage where it's like the balance sheet stuff really matters because we just came out of this sort of like credit crunch part of the crypto cycle where a lot of balance sheets were very impaired and a lot of firms had to reduce risk or, liquidate or whatever, right? So now we're at a point where that really matters and the technology part will be important, right? Like sort of like the user experience, the technology, the pricing, and the sort of like demand for trust and transparency and verifiability and real-time kind of visibility into dealer health and things like that. And those are all things that we're thinking about all the time at Arbelos. So like we want to kind of emphasize those aspects beyond just like table stakes of, having a balance sheet and having relationships with people as well. But it takes time. I think this cycle is sort of like moving in that direction now. Yeah. And you kind of see it in a couple of ways. Like we always talk about sort of the growth in the direction of institutional products like CME and the ETFs, things like that, and the volumes that are growing there. And then the other direction is sort of towards DeFi and sort of on-chain activities that are more publicly verifiable, in terms of both like the positions and the risk that people are holding on these venues, but also like where the collateral lives.
I know you and I have already discussed this like multiple times, but I'd love to share your views with everyone else like that's listening to this, right? Like, so with the ETFs now being approved, one of the key things that a lot of the option players in the industry that are very excited about is the opportunity to trade ETF options, right?
Yeah.
And most probably, right, like from a US perspective, like the hope that some of these ETF options start like showing up on, traditional exchanges, right? So do you expect that those ETF options are going to, see a lot of adoption early on immediately? Is that going to really affect the curve of option, trading, like notional trading volumes within the industry? Two, if it is a yes, where do you see that liquidity going? Is it going towards traditional exchanges forever, or do you see crypto native exchanges kind of taking some of that market share, continuing to be the dominant players?
Right. Super interesting question, very relevant to where I am today. And I think, it's a hard one, right? So I guess to unpack this, right? So we have to ask the question of options markets elsewhere in other asset classes. Who are the main users of them, right? So like in traditional markets and equities, you have a lot of retail users of options. Yeah. And, you have a lot of Robinhood traders of options.
The gamification of that stuff made things much, much easier for a lot of people,
So why is that true in equities, but why has that been lagging in crypto? And the reason behind that is because in equities, it's a highly regulated industry, especially for US equities, where retail participants can't actually get the degree of leverage that they want because of like, Reg T margin restrictions on their brokerage accounts. Yeah. Right. So, and there isn't, in the US, there isn't like a CFD or contract for difference or like a futures product on single name equities like there are in the UK or like other markets. Right. So to get the leverage people are just basically trading like these 0-day options, right? That's kind of like the Wall Street Bets thing. So why doesn't that exist in crypto? Well, the reason is in crypto, you have access to perps that are, don't have that restriction on leverage. So if you're a retail user, the way you get leverage is through perps.
You get up to 100x immediately, right? Yeah.
So what does that mean? So does that mean like options are relevant in crypto? Well, no, right? It means that there's other use cases, and particularly there's other audiences for which it's more relevant, which is like the institutional set of users that want options to construct payouts that otherwise couldn't be constructed, like limited loss payouts or, low premium leverage type payouts, or they want to extract yield from the market without constantly sort of trading the underlying asset, right? They just want to sell vol and get yield. Or they want to hedge their book, and they want to hedge it in an asymmetric way that you just can't do with perps. So, and I mean, the other obvious thing, which I was recently talking about this, is like with perps, as a retail user, there's no real risk of recourse to you personally. Like if you just trade on exchange, I mean, maybe now there is, like if you go back, like rewind like 2 years, there probably wasn't that much risk. Like now it's like there's a lot of KYC and stuff like that. So if you're a user and you're trading on leverage, I mean, if you use like a perp exchange, like a DEX on chain, like you're not really at risk at all, right? Like you put some collateral in, you trade a perp, it goes against you, you just walk away from that position.
Yeah, it's done.
But like for an institutional user, that's pretty much impossible. Like you're onboarded somewhere.
You're on the hook.
You're going to be on like someone, you're going to get sued.
Yeah.
So that's why options are much more important, I think.
But do you feel that the option, like adoption in crypto, aside from all the different reasons that you mentioned, like the economic reasons where like the perp essentially offers the same, if not a better experience for getting that kind of leverage. And in some fashion, it's just a simpler instrument. It's just straightforward, right? There's nothing, I don't have to learn Greeks. I don't need to understand what delta and vega is. But yet, those same Greeks apply to equity options as well. It's not, I mean, an option is an option, right?
Yeah.
And Robinhood was, as an example, was very successful at like just making those options look and feel like nothing but a bet on a price, right? Sure. Why do you think that hasn't happened in crypto? Why do you think hasn't been a retail?
It's because there's no, the retail is just using perps for that same gamification.
You don't feel like it's also a lack of option platforms that have been able to offer the same sort of gamified experience?
Right. I mean, there's been a lot of platforms that have tried this, and like I think someone will figure it out, but it would also take like some regulation around leverage in crypto, I think.
Yeah.
Basically. So, and then, I mean, to your earlier question too, just about like ETF options and how that's going to change, right? Okay, so let's say there are ETF options on Bitcoin.
So why don't we take it like step by step? First of all, like you believe those are going to get approved. What's the timeline?
Well,
what do you think?
It's going to happen probably faster than people think. But like right now, I think they're waiting on these exchanges themselves that want to list the options have to apply to the SEC for approval. So I think there's like a period going on, comments and things like that.
Okay, so let's say 6 to 12 months. Do you think that's a reasonable timeline?
Probably under 6 months, I would say.
Okay, now
I mean the thing you have to tell, it's like there's already they already exist. Like there's options on BITO, which is like the futures ETF, and then there's CME options. So they already exist. So it's like not like if you're a bank and you're structuring.
But the CME options are options on futures, right? They're not on.
They're options on futures that expire into the near term future, right? So it's like effectively on cash. Yeah, like if you're a bank, right, and your private bank is like, I want to, like a principal protected note on crypto, or I want to sell like a reverse convertible note on Bitcoin or whatever. Like you can structure that today because you have the building blocks already. So the question is like, okay, so why haven't those had like
adoption
volume relative to, let's say, a Deribit? Like I think part of it is this retail question, right? It's like, all right, so retail's not really involved in the options,
or if they are, they're involved.
If they listed any like IBIT options, would that change it? I don't think so, right? Because they already had access to the other ones. Plus, they already can go long or short on leverage with perps.
Okay,
so the retail, let's say, is not going to go there. Let's just say that. So then what happens, like what else drives it? So maybe it's the bank like structuring desks and things like that, but like they already had access to these other things as well. So why haven't they been able to do that? So it must be like a lack of maybe like dampened demand in this market environment from their end users, like the RIAs, whatever, the private wealth management, private bank type clients that would normally buy structured products. The last potential like user base is institutional users.
Yep.
So that's entirely possible, right? So like they might shift like most of their activity away from Deribit to CME and ETF options.
If that were to happen, why it's going to happen though? Like
the reality is like there are pretty large markets that don't trade on exchange that are what institutional users use to trade vol, right? So like FX markets, for instance, are mostly OTC. So yeah, it's really a hard thing to answer, right? Because the stuff like emerges, it's like an emergent property, and a lot of people will migrate from one. So I mean, one thing that is a good case study is just like, why has Deribit been so dominant? Like, why have they never been displaced? And it's largely because Deribit is sitting basically at the intersection. It's kind of at the fulcrum of like retail users and institutional users. And by retail, I just mean like people who want to use options that are not like large hedge funds, right? The kind of degens, like crypto degens and things like that. Like those people can touch Deribit. And now also like over the last like 2 or 3 years, institutional users can also touch Deribit. And a lot of that has been because of Paradigm and the sort of Paradigm opening up like the block market for Deribit. So if it's sitting there in this like midpoint, that's sort of the efficient venue for everyone to interact. And so that's why it's so dominant.
It's poised to make, I mean,
like CME is too far this way, and then like on-chain options are too far this way.
And too regulated too, yeah. It's like, but then the question is, one thing that you made very clear, like, earlier in your answers, like at least what it sounds to me is that like the biggest hurdle to option volumes like growing is perps.
Okay.
Right? Where and how and when do you see that like kind of not becoming an issue anymore? But like volatility kind of like goes down and like, the perps are no longer providing the same return. Yeah. And do we think that's going to happen like anytime soon, or like our options are going to continue on sort of a modest growth sort of, graph rather than the hockey stick that everyone was hoping for over the past couple of years?
I think, I mean, with like vol dampening for sure, right? Because it's less interesting to take linear levered risk. But I mean, I actually think it comes down more towards like the ratio of like institutional and versus retail users in crypto. So if it shifts more in like an institutional direction, then that's a benefit. That's a tailwind for options. And then if it shifts more back towards a retail direction, then that's a tailwind for perps.
And where do we see things on the institutional landscape? Do we feel that there are a lot more players that are going to start showing up over there? I mean, I know your client base is just purely institutional, right?
Yeah.
Same thing for Kemet, right? Like what we provide is technology for institutions, right? Like, I guess, what are your thoughts on the institutional participant like arena within this ecosystem? Is it growing fast enough? Are you seeing more participants like coming in and really trying to engage in the asset class, or does it just feel like it kind of plateaued?
I think the answer to that is it's much wider potential market than before, right? Because the ETFs open it up where a lot of people can actually hold crypto without too much of a compliance hurdle.
Yeah.
But that's like a very narrow way to enter the asset class. So if you can do that and nothing else, that's not really engaging with crypto in a meaningful way. Like it's engaging with like a very limited set of service providers, and like, it's a very vanilla way of getting exposure. So the real question is like, are institutions doing any of the other interesting things in the space, right? And interesting kind of by degree, right? So there's like, maybe you start doing like ETF versus CME futures and start thinking about the basis trade. And then maybe you start thinking about other market neutral strategies with options. And then maybe you start thinking about relative value between tokens. And then you might start thinking about like, venture investing and like the long tail stuff, or doing like fundamental token picking type strategies. So I would say most people are very bunched up in the front part of just like accessing majors through really regulated vanilla access vehicles. So like if I think about how we do business, a lot of it is still with crypto native firms that have been in the space for a very long time, that are largely very well versed, like fully understand what they're buying and selling, and are generally have like pretty good informational edge.
What a high barrier to entry, right? For a lot of people, if they're, most of these players they built enough like knowledge domain in a very small like sort of niche market, and then I guess there's not enough liquidity that like entices a lot of new players to come in, given that these existing players kind of also like dominate. I mean, I guess I just want to get your thoughts on like, we all know like it's like the 5-6
Right.
same market makers that are just simply making most of the volume in this space, right?
Right.
And when you compare that to TradFi, that's a very different world, right? Where they're
not that different.
Well, I mean, they're definitely. I mean, sure, there are big names, but there's
and there's
of course, but there's still in terms of size, there's a lot more room for players to play. Sure, maybe they're not going to be winning as big as those big guys, right? But I'm talking in this case, it's not just about 6 big players and then like 100 other small ones. It feels more like just 6 big players. Are there others out there that seem to be interested in kind of coming in and really competing with those?
I think there's a lot. There's a bias because you only hear about those names. But a lot of people are flying under the radar. There's a lot of small shops constantly, right? There's so much turnover in crypto of just firms that come in and out and do different things. And most people prefer to stay under the radar anyway, right?
Because that's just given the space altogether.
Exactly. Yeah. So I don't think that's right. I think there's a lot of players. It's a pretty diverse market. I think you get situations like now where the pendulum has swung so far in the direction of just like one dominating narrative around Bitcoin. And Bitcoin as a store of value, and Bitcoin as an inflation hedge, Bitcoin as this new investable asset class for macro participants. That's just drowning out everything else around maybe Solana, like you have a narrative there, but it's drowning out everything else in the liquid space. So then you get a situation where there's like, it feels like there's not a lot of people doing interesting things because people generally have the same trade on. It's just like market beta. But you just have to turn the clock back like a couple of years, and then a couple of years before that in the previous cycle where there were so many different narratives going on where you can even keep track. Like any given day, you just, there'd be like 20 new projects raising announcements. You'd have new VCs launching. You'd have like a new investment strategy launching around, activist investing in tokens or whatever, right? And then that, like, we're not there yet. Like, it doesn't feel like we're there right now, even though, and I've said this entire cycle where it's like, if we're trading near all-time highs, but it just doesn't feel like a bull market for most people. And part of it is because of that, because of just the monotone nature of the narrative.
That makes a lot of sense. I definitely agree with that, actually. I mean, you talked about other players like kind of being under the radar, like new, smaller, like, there's a lot of churn, obviously, in the player sort of, ecosystem. New firms come up and go every now and then. And, let's talk a little bit about edge, right? So, you mentioned, obviously, having some form of information, having some form of experience, like being able to kind of really build on top of that network effect, which at its core is just around trust, right? And you build trust not just by saying, but by doing, right? Which involves a couple of things, I'm guessing, like, so very robust risk management, and then the ability to be creative, right? So, coming up with a good trade is one thing, but executing it within the market is another thing.
Right.
So why don't we maybe explain to someone who might be interested in like sort of coming into this space as like, I want to be one of those players. What do I need from a technology perspective? Like, what's my stack looking like? What's stopping me versus the other players that are kind of like ahead right now, at least from a bare minimum perspective? And then maybe, tell us more about how you guys do things over there.
Yeah, so there is like a common stack, right? Like new hedge funds as they launch in crypto. Like you basically need a custodian, like usually it's a qualified custodian to hold your funds. You probably need some sort of like hot wallet or MPC provider solution that basically allows you to make transfers efficiently to your dealers, to your exchanges. You need to be onboarded with both like listed venues like the Binance, Coinbase, Krakens of the world. And then you need to be onboarded with probably more bespoke liquidity providers like dealers for both spot, for derivatives, for even sometimes for like repo financing type transactions. And then more recently, there's just been like more defined categories, right? So there's like this sort of prime broker category where it's like, it sort of combines a couple of these things. It can be a custodian, can be like a liquidity provider for you as a dealer, can also give you like direct market access to exchanges, things like that. So that's kind of your service provider stack. There's then if, you kind of have to decide, right? Like, what is the degree of direct market access you want as a participant? Do you want to just outsource your trading to these dealers that, you give them sort of like your parent order, they try to figure out what to do with it, and then they give you a price. Maybe it's like an agency price, maybe it's a risk price. Or do you want to have like a trader internally, like an in-house trader, and you give that trader, a system, and the system is usually like a PMS and then plus a order execution system. So yeah, that's kind of where to say. There's obviously different providers in each of those layers, including Kemet, right? Kemet's a good one for options and futures and derivatives. So it's a lot. Like there's a lot of different providers out there. There's very few that are providing services specifically for institutional customers and kind of have enough, I would say, enough of a clientele and enough of a history to kind of like have built a product that's very relevant to people in the space.
Yeah.
And then one thing I think that's like particularly different versus TradFi is the need for like constantly refreshing the product and sort of like rotating to different algos, to adding different venues and different counterparties, and then expanding the product set, because like that's just what crypto is. It just changes every 3 to 6 months entirely, right? So yeah, the ability for, it's, you know, like in TradFi, you've got an equities PMS that's existed for 20 years, like largely the same. Like there's no real need to like update it.
Yeah. I want to get your thoughts on like just being in this space since 2014, right? Like, and also, I mean, myself, I kind of come from a background in the TradFi world where for the longest time, right, the buy versus build was very much skewed towards like the build side of the world, right? Because there's a lot of lack of trust. I mean, especially with like cloud providers or like, you know, going, you know, offloading some of the proprietary tech to some third-party vendor, right? But I also started, you know, before I made the shift to start, you know, building Kemet, I recognized that there was definitely a shift towards like more buy versus build, because trust has started being built there. Things are a lot easier than they were before, right? In terms of like monitoring and having just better understanding of like how things work. In crypto today in 2024, right? As an institutional participant coming into that space, right? Where do you feel most people will fall on that spectrum, right? You know, if you had to give advice, right, or let's say you're advising someone else who's coming into the space, right? What would be your advice, like across the stack? What to build, what to buy?
Right. So my advice would be, think about what your competitive edge is going to be. And if it's something that you think is core to your business, you should build it yourself. And if it's something that is not core to your business and it's going to be largely commoditized anyway, then you just outsource it to someone else.
I mean, so
it's like a pretty obvious answer, but
yeah, of course. Yeah, but then the question is like, what if you don't have the resources to build everything? I mean, I guess what I'm trying to understand is like, because again, just like everything else in that space, right? There is also a level of maturity that the service providers have to get to a point where that buy also makes sense, right?
Right.
Do you feel that some of the service providers, including Kemet, you know, at this stage, like, are providing things that are...
No, I mean, look, if your edge is you have relationships and you have a really good sales and BD team and you can go find clients, and then you don't need to build anything. Hey, it's like you just outsource it to whatever your vendors are for execution, for risk management. But if your edge is actually like you can price things better than other people, then you have to build it yourself.
Of course. Yeah, and I think that makes a lot of sense. But I feel like not most people are Josh Lim, to be honest, like in this space.
Well, yeah,
so
that's right. So it's like, well, we have like a set of goals that we want to achieve.
Yeah.
So like, but there's plenty of firms that are very successful just by being largely like sales BD shops.
Now it makes sense to maybe dive a little bit deeper on like your user experience and your user journey with Kemet. I mean, you've been with us like since our beginning, right? We've definitely been through a lot, right? I'd love for you maybe to kind of like give us a little bit of overview, especially for those who are listening, right? Like, what are some of the unique strategies that you've been able to sort of like execute? You know, you buy the system. What are some of the value adds that, you know, whether Kemet or other systems might be able to provide in that space, right? Because I know, I mean, you trade volatility like no other, right? I think you definitely consider one of the top players here in the space, and I'd love to, you know, for you to share with myself and everyone else that's listening, like, what are some of those unique trades that you've seen recently that you've been able to accomplish using some of these systems?
Well, yeah, I mean, we've known each other for a while, and basically since my previous firm, right, we've always maintained a good relationship. I think, the product is useful for many reasons, but obviously a big part of it is just there's plenty of ways to sort of access like screen markets for options, and some of them require maybe different types of approaches, right? Like passive approaches or more aggressive approaches, or block trading on Paradigm, for instance, is another approach. And sometimes you don't want to touch screens at all, right? So I think what we found is like the some of the tooling that we use with Kemet has given us like some flexibility in terms of how we operate in those different modes. And it can be helpful from from like an edge perspective, like in terms of just capturing more edge. Sometimes it's more of just like an informational thing. Like we want to be careful about how we interact with the market. And we don't want to sort of like interact too aggressively or too obviously. And so there's certainly some benefit to that. And I think, we obviously think of our infrastructure as like many different things. We have like our own internal tools and we have a broad set of vendors, but think, like you guys have particularly focused on like this niche of options and futures. And I think that's like a nice part of the crypto industry that's like relatively underexplored, right? For other providers. So yeah.
Absolutely. I'd love for you to share with everyone like just the fundamentals of like risk management that like made everything blow up over the past couple of years and how you guys are trying to change things. Because I know like you and I have discussed this like a lot of times, like even when you were kicking off Arbelos, right? Like you're trying to fix this counterparty risk problem, right? Which at the core of it is just like real-time information on, am I liquid or am I just about to get wiped out?
Right.
Maybe tell us about like, what are your, plans on solving for this problem, like with uniquely on Arbelos and sort of how are you approaching this risk, like fundamental risk issue?
Right. Yeah. So if we just think back to what happened last cycle, I mean, a lot of it was driven by a lack of transparency into what risks were being taken on by major market participants, right? And so, notably, like some of the bigger defaults came from, people taking too much risk and maybe having the same risk exposure across multiple venues, across multiple dealers. And so with that in mind, we built Arbelos to really be as transparent as we can be with our counterparties while still sort of protecting our risk position and the confidentiality of clients and things like that, but allowing ourselves to win the trust and win business with counterparties by sharing with them whatever kind of risk information they need about our balance sheet so that they feel comfortable trading with us. And so that's one of the key tenets. I think you can achieve that in a lot of very technical ways, like technical ways that exist for blockchains as well, by revealing information kind of selectively or in a way that's verifiable by third parties, or using sort of the cryptographic kind of techniques that allow you to verify those things. So that's one of the areas that we're investing in as a firm, just build like a little bit of a technology edge around being a centralized dealer that people can trust, right? Yeah.
Makes a lot of sense. Do you see DeFi growing in institutional adoption at all? I know like this has been a question been asked for far too long. And at least from my perspective, like all the signals are just showing that like it just hasn't been picked up. Like it's the scale that everyone wants to see being picked up. And I'm not talking derivatives. I'm talking just DeFi in general, right?
Yeah.
Where do you see that going?
I think that DeFi has its place amongst like a certain user base, and it is basically right now very crypto native market participants, like retail market participants. And so
just driven by degens, right? Like it's kind of
exactly. And to the extent that segment of the population isn't growing by leaps and bounds right now is probably why like metrics are kind of the same, right? But I don't think that means it's dead or that it hasn't proven something, right? It just means that it's something that maybe requires like a lot of exogenous things to be happening. Like we talked a little bit about how Bitcoin is driving the major narrative in crypto today. And Bitcoin is, I mean, you have like wrapped BTC, but it's not generally accessible beyond that in DeFi. I think that's one of the big reasons why DeFi is like kind of in a rut right now, is like it's not connected more broadly to other narratives like the store value narrative for crypto. So I think things will change, right? It's not gonna be like this forever. So when there is, and there'll be like a DeFi summer 3.0 or whatever, right?
Do you feel that like the RWA movement, like with Biddle and Ondu and all those like new sort of, I guess, vehicles, right? Like on chain, do you feel that's going to help the case for DeFi?
I think so. I mean, yeah, like so many things in crypto are effectively these wrappers on other assets, like the LSTs and things like that, right? So of course, the security model around those is very different. And for RWA, you have to trust the custodian of those assets. But I think it does open up so many things. Like we recently published an article on our website about RWA and like certain ones that have gotten traction, like the gold tax-shi. And, the fact that it's importing a lot of crypto ideals into its market market structure that don't exist in traditional markets is kind of interesting. Like the fact that it's like a 24/7 accessible product, that it is globally accessible by a lot of market participants instead of like just institutional participants, let's say for, COMEX futures or whatever. So we're kind of at a point where the convergence of all these like crypto ideas into traditional assets is going to really change, like maybe even change the way the traditional assets work. Yeah.
I agree. Josh, again, thank you for the time. I think this has been an incredible conversation, and
Cool. Had a
hopefully
great
a lot of
time.
people are going to be enjoying this.